Hello and welcome to today's personal finance show here on Dublin City FM with me, Conor Byrne from askpaul.ie. Yes, the budget had loads of good news for businesses, but today I want to focus on what matters most to listeners' back pocket. How has this budget helped you? First up, let's acknowledge the fact that this was supposed to be a budget that had something for everyone in the audience, a bit of a late show budget, but in reality it was a little bit more like a budget that gave a little bit of something for everyone in the audience. Overall, the budget kind of set out a package of 10.5 billion in spending. Now, I know that number is a bit of a funny number to try and get your head around. It's a mad number when you think about it. But it was made up of a few different packages or pockets of spending within the 10.5. There's a package of one-off spending measures worth 2 billion, total expenditure of 6.9 billion, an additional capital expenditure of 1.6 billion, and permanent tax changes of 1.4 billion for 2025. That means nothing to a lot of people. I know that even the 10.5 billion overall spend, you're like, well, what does that really mean and how does it impact me? And that's what we're going to focus on here today. The big one for most people is tax. What is happening with my taxes? And the simple answer is that you're going to get taxed less. Okay, so there has been an increase in the tax bands. But what does that actually mean again? So the standard rate of tax has been increased from 42,000 euros to 44,000 euros. That means you're not going to hit the higher rate of tax unless you earn over 44,000 euros a year. And the 4% USC charge is going to be decreased down to 3% a year. But that normally hits people who earn an income over 27,000 euros as well. The way this has been pitched by the government is they say that most people will benefit on average by about an increase of 1,000 euros over 12 months. But of course, to see exactly how this budget is going to help you and your own finances over the course of the year, head over to askpaul.ie and you'll be able to see on the Ask Paul budget breakdown document what those specific changes are. What are the changes to tax? What are the changes to rent and mortgage relief? Social welfare changes, etc. So it's a great document to be able to jump in and see in simple and easy to understand language exactly how this budget for 2025 is going to impact you. However, I can't stress enough that it's really up to you to power your finances and figure out exactly what to do with your finances. So don't leave it up to the government. Obviously, the budget every year is a bit of a headline grabber for the government. We're reducing taxes, we're spending more, but you're the person who is ultimately in control of what happens with your money. Don't leave it up to the government. But how do you do that? It's simple. You sit down and devise a financial plan, work on your own budgets, figure out what am I earning every year, how do these increases in my take-home pay and my reduction in taxes actually help me, and what can I do with that money going forward year on year. So the biggest thing I would say every time that the budget comes out and people get in touch with us and say, hey, budget's out, I know I'm getting taxed less, what should I do? Is to sit down, devise a financial plan, figure out what you can do yourself to change your finances going forward and put a financial plan in place. So, for example, let's say you're saving money every year, you might have some money saved in an Irish bank account, but that Irish bank account could be giving you zero interest every year. Okay, you're not getting anything back on holding your money with that Irish bank for leaving it there. However, if you take some steps, sit down with a financial planner, see what's going on with what's available for savings out there, and you put your money into something that gets you at 3% interest every year. So 50 grand held in an Irish bank getting zero gets you zero. If you put it into something that gets you 3% interest every year, you're going to make 1,700 euros extra every year. And even after you take the tax off that 1,700 euro, that's still going to be about 1,000 euros more each year into your back pocket. So there you go. The budget is giving you an extra 1,000 euros each year, but most people in Ireland can take steps with their personal finances and their personal budgeting to be able to get that extra 1,000 euros into their back pocket with other measures at their disposal. Okay, with every budget, it's always down to how individuals are impacted that will decide if this budget is going to be good or bad for you. If you want to know more about how it impacts you, another great way for you to figure out how that hits your own bottom line at home is head over to the PwC income tax calculator, which every year they update it really quickly following the budget, and they'll do an income tax calculation where you plug your details in and you'll see how your taxes in 2024 will compare against your taxes in 2025 with these new budget features built into it. So during the week, Paul asked our Instagram followers what they thought of the budget, and here are some of their comments. So it was a mixed bag, to be honest with you. There was a broad range of different comments that came in. So Darren says, as a self-employed person, I didn't see it help. Not much incentive to work for yourself, in my opinion, which is something that I think that the self-employed community have been saying for a good few years now. And I know in previous governments they brought in, or they tried to bring in a bit of a rebalancing of how the self-employed workforce of Ireland is treated in terms of PRSI, etc. But yeah, no, another budget that kind of questions how self-employed people actually feel following a budget like this as well. Clive says, sure, they just take it back with increases in fuel, etc. It's not as rosy as they say. And yeah, that's true every year, like clockwork, different things like the fuel, cigarettes. No increase in alcohol actually this year, which is an interesting one. Normally you see increases in alcohol. So that wasn't increased, but yeah, that's a good point there, Clive. Other comments we have, and this is a bit of a theme throughout the different comments that we got during the week. Chris says, housing, the government can't just seem to understand the supply and demand principle. And a lot of the comments that we got during the week regarding the budget focused around the housing issues of the country. So I don't know if this government are of course they're listening to people, but the population are screaming out, especially the people who are looking for mortgages and houses, and those people that feel squeezed out of the housing sector at the moment. They are looking for key aspects of the budget that are going to help them get houses. And there wasn't a lot of stuff in this budget which helped people to get their new houses. Now, the Help to Buy scheme has been extended. That's something that is, of course, going to help people buy new houses. But then a common theme that we saw throughout the questions as well is people are asking for the Help to Buy scheme to be extended out to second-hand houses. So that was an interesting point. I think the principle of the Help to Buy scheme was to try and stimulate housing building activity. So focusing on the fact that it's only for new builds, is something I think that the whole principle of the Help to Buy scheme was ultimately built for. What else do we have here in questions? Sarah Byrne saying the middleman has been screwed over once again. So yeah, that's a fairly common sort of tone or theme that we see with most budgets coming through every year. Now we've one here from Lorcan who says, great, that's an extra €1,000 more towards my private pension annually. So that 1,000 that the government are saying the average person should have in their take-home pay over the course of a year, Lorcan feels that that's an extra €1,000 that he can save in towards his pension. And of course, if Lorcan's saving that into his pension and he's a higher rate taxpayer, he's going to get a 40% discount on that €1,000, which means it's only costing him €600 each year to save that €1,000 into his pension. So interesting take on it there from Lorcan as well in terms of what he's going to do with that money every year. Mr. T here says, nice to get the extra cash, but the services need money. Okay, so again, that's another theme that we saw coming throughout the comments during the week, is that people are kind of saying, okay, fantastic, an extra €1,000 in my take-home pay annually, but the country's on its knees in terms of the housing sector, as we talked about earlier, but then overall infrastructure and investing that money back into how we actually live our lives in Ireland at the moment is something that a lot of people are focusing on. So we see ourselves as this home for multinationals. We're bringing in people from all over the world here to work in these multinational companies, the tech sector, the pharma sector, the healthcare sector, etc. And our infrastructure system is on its knees at the moment as well. So that was a bit of a theme that we saw throughout the comments from people during the week as well, about what are you guys actually doing to get the infrastructure and the way the country runs, up to a better international standard. McG San here saying, delighted to get the mortgage tax relief again, wasn't expecting it, delighted. So that's focusing on the fact that the government have extended out the mortgage tax relief scheme. That's something that was done. The original mortgage tax relief scheme was for mortgages that were pre-2012. That was kind of stopped in 2022, and then a temporary mortgage tax relief scheme was brought out in 2022, and the government have kind of came out and said that they're going to extend that on again one more time. So we might dive a little bit more into that one later on about how the mortgage tax relief scheme works and make sure people understand exactly how it will help them. And then we have here from Now Mile Geo saying that they're fairly happy, to be honest, thought it targeted all, understand the why behind the Apple windfall budget is what they're saying. So I think what's important, and everyone's going to be talking about the 10.5 billion that I mentioned at the start of the show and how that's been allocated towards day-to-day spending of the country, I suppose is the best way to put it. There is the elephant in the room, which is the 14 billion that the government have received from the Apple tax windfall saga. So that's not going to be counted in this budget, okay? They're very clear that the 14 billion that they've gotten from the Apple tax decision has to be allocated towards, I suppose, capital expenditure or putting it into housing or infrastructure, as we talked about earlier. So none of the items that we're going to talk about that have come into this week's budget and this year's budget are going to be focusing on an Apple tax windfall. That's going to be very separate from all of this as well. So the government have to figure out, and the government have to try and nurture your votes, I suppose, for want of a better phrase, with the 14 billion as well. So that's going to be a different kettle of fish for them to get stuck into over the course of the next while. I'm confused as to what parts of the budget are already in place versus what's starting in 2025. Can you explain? Okay, so really good question. The announcement of the budget on the 1st of October from the two ministers is their budget announcement, is the best way to put it. And they're really talking about the headline stuff there. They're talking about the stuff that's going to hopefully, and this is what the commenters would say, is to try and sway some votes. It's all the good stuff. It's all the nice stuff that people want to hear. Reduction in taxes, tax reliefs, mortgage interest reliefs, all these different things are talked about. But none of that detail is going to be put in black and white until they publish the Finance Act, which is going to probably be published early next week. So generally about a week after they make the announcements in the Dáil, they'll have the actual Finance Act published. Then it goes into a couple of weeks and months of debating the Finance Act. So that has to obviously pass through the Dáil, that has to get voted through. So that takes a good few weeks or months, as I said, to finally get it over the line. And that'll get written into law come the 1st of January 2025. Okay, so I know it's October now and they've talked about all these windfalls and all these different things we're going to get, but a lot of us won't actually see that happen until the 1st of January next year. So what actually is in place now and what actually is in place come next year, all the bad stuff, the best way I phrase this to people is the bad stuff happens now. So your increase on fuel, your increase in cigarettes, VAT changes, because they're already written into law, that'll happen now as of midnight on October 1st. And then all the good stuff, so your reduction in income taxes or tax reliefs, etc., that'll come 1st of January 2025 or even midway through next year. So it's a great question. What can I expect to happen now and what can I expect to happen in a few months? And that's the best way for me to answer that. The bad stuff now and the good stuff comes a little bit later on. Okay, great. So next question. I keep hearing about mortgage interest relief, but told I don't qualify as my mortgage is 550,000. Surely the higher the mortgage, the more interest and the more impact I should see. Very unfair. Yep, another great question. What might be useful here is to go into how the mortgage interest relief works. Okay, so it sounds great. I get relief on my mortgage interest rate, but what does that actually mean in real terms? So as I said earlier, the concept of mortgage interest relief was something that was brought out for mortgage holders pre-2012. If you had a new mortgage after 2012, you weren't included in it. But then with the hike in interest rates in 2022, the government had to do something about it because interest rates were spiking dramatically on people. They had to give some level of relief to those people who were suffering those increase in interest rates. So in 2022, in that budget, they brought in a new mortgage interest relief for new mortgages, for people whose mortgage interest rate jumped. That was the whole concept behind it. So the best way for me to maybe talk about this is to use a working example. So let's say in 2022, you had a mortgage and the interest on that mortgage charged you €9,000 a year, okay? And then the year after, your mortgage interest rate went up, and then all of a sudden, your interest charge on your mortgage every year was €12,000. That's a $3,000 a year jump in your cost of your mortgage just purely on interest. It's not paying down the capital, it's just how much the bank are charging you to borrow that money. What the government did in 2022 is they brought in a temporary interest relief, which meant that €3,000 increase, or 20% of it, could be claimed back as a tax relief, okay? So that equates to about €600 a year you could get back as a tax credit. Now you'd have to go on to Revenue Online and claim that credit, tell them that you have this mortgage and the interest rate has gone up and you're being charged more, and you get that credit back, and it's capped at €1,200 a year or €1,250 a year. But obviously this listener is asking why my mortgage of 550,000 isn't qualifying for it, and it is mortgages over €500,000 don't qualify. And I suppose the rationale, the logic or the why on that is they feel that people, they're really targeting people that are in the median house purchase range there and the median house purchase across the country. So obviously different parts of Ireland have different property prices and are subjected to different property fluctuations, and property prices everywhere are going up now, I think, at the moment, but more heightened in different parts of the country, and particularly in Dublin. But the average purchase price of a house around the country is in or around that median range of about 300, 350, 400,000 euros. So the logic of not bringing people in who have mortgages over the 500 grand mark is that they probably feel they have the means or the ability to pay that themselves, or to sustain that cost themselves. So that's why people weren't brought into it. But it's important to understand how mortgage interest relief works, and why it doesn't bring all range of borrowers into the scope of the mortgage interest relief scheme. I'm up approximately 2,200 per annum after the budget, which is great. That's a little bit more than what we talked about earlier with the government feel is the average of about 1,000 per person. So this person's up almost double the average, a little bit over double the average. And this person actually, they say they use the calculator from PwC to figure out exactly how much more they're up. And it could be a household basis here. We could be looking at 2 people in the household earning income. And the question is, what should I do with that extra income every year? Should I put it into a pension? Should I overpay my mortgage? So it's more of a financial planning question here, which is a great question to ask. And it's what I go back to at the start of the show and talking about, to understand what you can do with how this budget changes or improves your finances, is to sit down with the team in Ask Paul and devise a personal financial plan to understand exactly how to use that additional money in your back pocket every year. So I think what you have to do when you think about what you're going to do with the money is you're going to have to look at the overall financial planning wheel. What different aspects of my finances have I got in control? What am I lacking in? Where should I apply the power of that money? So I think you have to go through, what are my savings like? Have I got enough of an emergency fund set aside? Have I got zero savings? Have I got zero savings because I have too much debt that I'm paying back at the moment? And what's my retirement pot looking like? If you have all those previous boxes ticked, well then maybe that 2,200 could be passed over to a child savings account. It could be used to boost your investment savings, or it could be put into a pension for retirement age. So you have to kind of go through the financial wheel of what's filled, what's not filled. Am I lacking here? Am I lacking there? But I would be 100% looking to book in for a financial planning consultation to figure out exactly what the best way to unload that €2,200 is. Great. The next question here is, I see inheritance tax thresholds have increased, but I'm an only child and the €400,000 threshold, although helpful, still leaves me with a large liability. Any way of reducing that liability? Yeah, fantastic question. And the inheritance tax threshold of €335,000 is something that is almost like a badly kept secret. It was one of those things that the government were letting slip through into the public realm to make themselves look good to a certain degree, but it's way overdue. That should have been increased a long time. Sure, the €335,000 limit, it's come up really slowly over the last 10 years, but it was brought back down to that level very much post-recession 2007, 2008, which was a mechanism that the government used during the austerity years to try and get their hands on more tax. And it was not rapidly increased back up over time as the country started to get itself back on its feet. So it's great to see the threshold coming back up, but we probably still feel it's got a long way to go to have a real impact on people overall. And in this situation, I suppose this person's saying that the €400,000 limit still leaves them with a large liability. And I suppose to unpack that a little bit more, if this person was to inherit their family home, and that family home is €600,000, which isn't unreasonable given prices in some parts of the countries now, they get €400,000 of the family home tax free, and €200,000 of the family home will be liable for 33% capital gains tax. Okay, so Mr. Revenue will come knocking once the estate is settled, once probate's granted, they'll come knocking and looking for a third of the €200,000 on that family home, which is a really unpleasant thing to think about, that the revenue come looking for their slice of the cake in situations like that as well. But there are ways for families to plan to reduce or almost get rid of that inheritance tax bill, that capital acquisitions tax bill. It's a real hot potato. Like, no one wants to think that you've lived your life, you've paid all your taxes, you pay your income tax, you pay taxes on investment gains. They get a little bit of your money everywhere you turn in the universe of taxes at the moment. So inheritance tax is a real provocative sort of tax to think about. But what can you do to try and get that tax bill down? Well, not a lot of people know there's a small gift exemption every year. So families can pass money over gradually over time. Each person, and actually this doesn't apply to families, this applies to strangers. You could pass it to a stranger in the street if you were generous enough to be able to do so. But anyone can gift anyone in Ireland €3,000 a year tax free. Okay, so if you think about that from parents to a child, 2 parents, €3,000 each, 1 child, that's €6,000 a year. And every year that they give their child €6,000, none of those €6,000 gifts form part of the overall tax bill. So to go back to that example, if say someone was to inherit the family home was worth €400,000, and the parents had cash assets or investment assets or pension assets, whatever it is, over time, and they slowly drip fed that money over to the child in their retirement years, then that would reduce the overall tax bill. You could pass money over to grandchildren, so grandchildren being family members, they could receive €40,000 tax-free from a grandparent. You can put in place Section 72 life insurance, which is a life insurance policy which is designed specifically to pay the tax bill, so it doesn't form part of the overall estate, which means that when the last parent passes away and this money passes over to the child, the benefit from that life insurance policy is qualifying for Section 72 relief, and therefore is designed to just clear the tax bill straight away. Now, if you can't get life insurance, then Section 73 is another financial mechanism you can use to try and get that tax bill down. But all of these different features, a good detailed financial plan on what you should be doing to try and mitigate that tax bill, can be covered in a financial planning consultation. So again, they're currently free at the moment. Head over to askpaul.ie and book yourself in for a financial planning consultation.